agencies don't receive. And I think I said yesterday that the Secretary of Defense has authority to disperse funds. Okay, not every agency has that authority. If you're in any of the other agencies, Treasury disperses all the funds for you. But DoD has, or Secretary of Defense has authority to disperse funds, and he delegates that authority down to DFAS. So Title 10 gives DoD authority to perform dispersing function. This stuff's been codified under Title 10. And so this gets delegated down to what we call DOs, dispersing officers. And these guys, when they're established, they act as agents for the Treasury. So dispersing officer, they run the operations of a dispersing office. But again, they're doing this in support of DoD, but they're acting as an agent of the U.S. Treasury. In DoD, and you don't need to write this down, but we've got somewhere in the neighborhood of about 326 dispersing offices around. Okay, and if you look among and that's spread among all the services, all of that 326 or so, Navy has about 200 of them. Why? Because we have ships, and the ships do disperse funds. Okay, so these are what we call tactical dispersing offices. In DoD, we have both tactical and non-tactical dispersing offices. The tactical dispersing offices are established by the service. Okay, so the service designates that it's a tactical dispersing office. The non-tactical ones are established by DFAS. So if you are a tactical dispersing office, you have what is called a DSSN, a dispersing station symbol number. You want to make sure you either highlight that or write that down. Okay, DSSN, the dispersing station symbol number. And what this is, it's an identification number that indicates the authority to receive and disperse funds and issue checks on behalf of the Treasury. Okay. What the DSN does. It's authority to receive and disperse funds and issue checks on behalf of the Treasury. They can make payrolls, those types of things. These DSSNs are assigned by the Treasury to DFAS. Okay, and they include the location of each specific office and the dispersing office's identification. So those are what we call tactical dispersing offices. Now, if you're a dispersing officer, you're responsible for safeguarding the funds, right? And so DOs, it says, must faithfully and promptly make transactions directed. As I said, nothing gets paid that hasn't been certified. So since you're actually dealing with funds in many cases, there are things you must, and you cannot do. What you must do is you have to safeguard those funds. Okay, so they have to have good internal controls, and they also have to have safes to actually that must be locked and secured. Okay, so you must secure those funds. Those are the things you must do. Things you can't do. There's 4 things you can't do if you are a dispersing officer. The funds that are in your possession, you cannot loan them. You cannot loan those funds out. You cannot, as I call, invest those funds. You cannot deposit them. Okay, try to make money on it. Try to earn interest. You cannot use those funds, of course, and you cannot exchange them. Okay, so you can't loan them, you can't use them, you can't invest them, and you can't exchange them. Okay, your job is to disperse for what has been properly certified. Now in DoD, we have a lot of things. what they call non-DFAST paying offices, and these are things like PSDs, shipboard dispersing offices, the financial service offices, and so on. And so nothing testable there. Most funds are made by EFT, electronic fund transfer. We'll talk about that briefly. But when we're issuing disbursements to other federal agencies, and there's a system called IPAC, and I'll get a slide on that later on. IPAC stands for the Intergovernmental Payment and Collection System. Okay. So we don't cut checks back and forth to other federal agencies. We do. This is all done by electronic fund transfer, and we use this IPAC system to transfer money. If I owe money to the Department of Interior, it's done through the IPAC system. So make sure you know what a DSSN is, the dispersing station symbol number. Okay. So EFTs, I talked about EFTs, electronic fund transfer. Again, a little genesis on all that. You know, much of what we did in the government changed when the computers became more popular and we started using more, you know, electronic means back in the 90s. There's a law, and we'll probably see it when we get into accounting. It's called GMRA, the Government Management Reform Act. And this was one of those laws passed in 1994. And one of the items that was included in this law, it required federal wages to be done via EFT, electronic funds transfers. Everything before that was, you know, payday was every other Friday, and someone in your office would go down to the front office and they'd come back with a stack of government checks, and they would go around the room and here's your check, here's your, you know, and you would get a check, and then you would also got a white piece of paper that had your leave and earnings statement on it. Okay? That's how payroll was done. Well, you know, in the 90s, we were trying to take advantage of all the new features that and the capabilities that computers were bringing to us, and looking at ways to save money. Treasury checks, it used to cost Treasury somewhere in the neighborhood of $1.03 just to process a Treasury check, just to issue a Treasury check, paper check. Electronic fund transfers, it's, you know, pennies compared to that. So it was a big money saver to the federal government to adopt EFT. And probably 98% of what we do in the government is done via EFT these days. And you know, we still do Treasury checks and so on, but again, the bulk of what we do is done electronically. If you receive your payroll and it gets deposited into the credit union, there's this thing out there called the automatic clearinghouse. If you look at your payroll stub, or look at not the payroll stub, you look at the credit union, you will see an abbreviation, and it will say ACH. ACH. That's the automated clearinghouse. This is a network that's used by banks, it's used by companies to transfer money for secure payments. It's a transfer system, and it pretty much connects all U.S. financial systems. This is huge. I mean, if you look at how much money moves over the ACH every year, it's anywhere between 40 and 50 trillion dollars of transactions. You know, the billions of transactions, 20, 30 billion transactions themselves, but 40, 50 trillion dollars worth of transactions. When we're, you know, if you look at what's going on in the world right now, and remember they were talking about should we take Russia off the SWIFT system, SWIFT. The Swift's this system, it's hard to say, is pretty much like that, but it's even bigger, and it's done uh, kind of worldwide. And most countries are on this. This is a very similar system, though. It's a banking system. It's a transaction system. Um, it contains even more money than 40, $50 trillion a year transferred over this. And they're thinking by hopefully cutting Russia off this really takes them out of the loop as far as financial transactions are concerned. Anyway, as I say, Treasury still can issue checks for military pay, civilian pay, those types of things, travel claims, and so on. But most of our funds are done via EFT. Now, I'm going to talk about large disbursements here. I mentioned earlier that Treasury, one of their big functions is money management. There's an office up in the Treasury called the Bureau of Fiscal Services, and it's a pretty good sized office. A couple thousand people work there, but they are responsible for managing the government's daily cash flow. And this office in itself has a daily cash flow of about $70 billion a day. Think about that, 70 billion. This is money coming in, money going out. We all don't just pay taxes on April 15th. Tax money's coming in, and money's coming in from all over, different sources coming in every day, and money's going out every day. So they have a daily cash flow of about somewhere in the neighborhood of $70 billion a day. But they don't keep that kind of cash on hand at all the time. Remember, I said they only keep several days worth of actual cash on hand. So when we are going to make what's called a large disbursement from DoD, we have to give them notice that let them know in advance, depending on the size of this, how large a disbursement this is going to be, so that they can be sure they have enough cash available. I told you yesterday, one of the guys we used to work with was kind of the deputy comptroller. He was the SES that I mentioned that had worked at the Pentagon. He was probably one of the highest ranking guys in the Pentagon. That was a government employee, not a political appointee. And he was telling us a story one time that he was expecting a large disbursement to be made in excess of $500 million. That's okay. And he was expecting this large disbursement to be coming due. So he called up the Treasury and said, "Hey, I got this almost $1 billion disbursement coming in. Just giving you a heads up. Just giving you a heads up." And anyway, for whatever reason, that disbursement didn't materialize. Didn't happen. And he never thought anything about it until he got a call a couple days later from the Secretary of the Treasury, chewing his butt out up and down. And he basically was saying, "You realize what you did?" And the guy goes, "Well, no, tell me." And he goes, we didn't have that kind of money available. We had to go out and borrow that money. We are now paying interest on that. And now you say you don't need it right now. Okay. So after getting reamed out, there was further reaming out taking place down the chain, but he just realized how important that really was for the Treasury to have that good, timely information. So in your book, and I'm gonna read these out, we have to give notice to Treasury if the expenditure is going to be $50 million or more in a single transaction. Okay, we have to give them 2 days notice before the payment is made. So if it's $50 million or more in a single transaction, they need 2 days notice. If it's 500 million or more, we got to give them a minimum of 5 days advance notice. 500 million or more, five days advance notice. And Military pay. Think about, military pay, or everybody's getting paid pretty much at the same time. They have to give them 2 days advance notice. What I think they do is they give them the calendar for pay ahead of time, but they still have to give them 2 days notice before military payday. Again, this is just to make sure there's enough cash available at Treasury to liquidate the those debts. Skip over that slide. It's out of place. Okay. Talked about the electronic fund transfers. These are all examples of electronic commerce. Okay. I don't think you're going to see a test question on these, but these are things like electronic document access. What that does, it gives secure online read-only access for vendors. Vendors could go in there and they could see contracts, contract mods, bill of lading, things like that. Again, it's read-only access for contracts and vouchers, things like that. Electronic data interchange, EDI. It's a method of moving business information using a standard format. Okay, again, it's a bridge, computer to computer transfer. What's not on here? Electronic signatures. Some of you probably have PKI ability, public key infrastructure. Okay, where you electronically sign. Like you do a digital signature on documents. You don't get writer's cramp anymore. So these are all examples of electronic commerce. A lot of these things, again, back in the 90s, in the late 90s, there was a law passed called the Paperwork Elimination Act, 1998. And this act required individuals and companies that deal with the government to start working electronically, start submitting information electronically. Okay, so there was a push on, by Congress and the White House to start taking advantage of all the new electronic capabilities that are out there. So these are just some examples of all of that. Electronic fund transfer exceptions. These are other examples of EFTs. Okay, there's this thing called Vendor Express. Vendor Express electronically transfers money and remittance information through the automated clearinghouse network. Okay, so it transfers both money and payment information to vendors. We use that. You may want to highlight Vendor Express, highlight it in your book, and put a little note by it if you don't have a book. Okay, what it does, it moves, transfers money and payment information to vendors. You guys are probably pretty familiar with the government purchase cards. Okay, those are big change in business for the federal government. Let me give you some notes here, right in place. And some of this has changed because of our, because of the fire, our efforts to get clean, audible opinions. It says card holders will retain copy of their monthly statements of accounts and all supporting paperwork for a period of 10 years after the end of the fiscal year involved. Okay, so you need to, if you're a card holder, you have to retain copies of the monthly statements and supporting paperwork for 10 years. It used to be, and I'll talk about this in a little bit, it used to be 6 years and 3 months. It used to be 75 months. There's this law I'm going to talk about called the Barring Act. But now, because of the fire, the Financial Improvement Audit Readiness Group, they want this to be retained for 10 years. There's this other thing, it's not listed on the slide, it's called card acquiring services. Okay, you can pay your income taxes with a Visa. What this does, this is a treasury program that permits federal agencies to accept credit cards. So as I said, you file your income tax. If you haven't already done so, you can actually pay them with a Visa. They're going to charge you a couple extra percent, right? But you can pay with your Visa. And if you're working and you have this in place, vendors can return overpayments by credit cards. Okay? If we've overpaid a vendor and he needs to return money to us, they use these card acquiring services. Gives us capabilities to accept credit cards. And the last thing here is this thing called the General Lockbox Network. And this gives us, these provide services that include processing and making deposits and transfers. What it is, it becomes an agreement between the agency, Treasury, and a lockbox bank, okay, where you can process and make deposits and transfers, okay? Lockbox collections. So these are just other things that have come about because of EFTs. This slide, this is one of those add-on slides. We've covered a lot of this stuff. Let's just look at the very last part here, the last part of the page. Talked about obligations, again, legal reservation, payment packages. Remember, payment packages, certifying officers have to make sure it's before he can certify anything, that's a proper payment package. Voucher certification, again, certifying officer. Disbursement outlay, then that's done by DOs. When they make that payment, that becomes that's money that is taken out of your cash balance. And we said that the other day. And we'll talk more about this when we get into accounting. That's your fund balance at Treasury. Way back on Monday, I talked about whenever a Treasury warrant is signed, one of the things it does, it moves money from the general fund and it puts it it earmarks it in the Treasury as your fund balance with Treasury. So when the disbursement and outlay is made, it's drawing down on that bank balance. It's reducing your fund balance at Treasury. So that's pretty much cradle to grave there and everything, that whole process from appropriations all the way down to outlays. Collections. So in DOD, we use, when we have voucher collections, we use this a form, and I'll write this down. It's a DD form 1131. It's called a cash collection voucher. And collections can be either vouchered or unvouchered. Pretty much everything we do is considered a vouchered collection, if we're dealing with checks, cash, those types of things. All formal collections are done as a vouchered collection. But an unvouchered collection, let's say you owe the government money and you don't want to pay them. Well, they're gonna do some pay checkage on you. Okay, that would fall into this category of an unvouchered collection. Okay, they're doing pay checkage on you, so it's not vouchered on 1131. They're just going to take it out of your pay. I talked about, here's those 3 R's that we've talked about a couple times this week. Types of collections. Remember, we said receipts. You have to have statutory authority to accept a receipt. I called them OPM, other people's money. If you do not have statutory authority for receipts, then that gets deposited into miscellaneous receipts in the Treasury. Reimbursements I said, are monies that we've earned by doing work or service for someone. And refunds are recoupments, they're extra payments. We get to keep that money. It always goes back to the year in which the original transaction was made. If those years are now closed or canceled, then it goes into miscellaneous receipts to the Treasury. An indirect collection. This is when you collect on behalf of a dispersing officer. Okay. When I told you for a couple of years I was the accounting director at BuMed, and I don't know how things are done there now, but in my office, I had someone that worked for me that served as a collection agent. Okay, and the way it worked was all the hospitals at that time, we had like 78 hospitals around the world. If someone walked into the hospital and they weren't, they weren't military, or they weren't really entitled to, Navy medical care, they just came in off the street, the hospitals would bill them. Okay. Well, and they would follow up for a certain period of time, trying to collect all the money that they were owed. After they got through a certain, they deemed their account uncollectible, and they would send it up to my office. And one of my functions was, I had this collection officer then that worked for me. She would follow up. She would do follow up trying to collect this money. And she would issue dunning letters to these people. And, some of them would set up payment schedules. They'd pay $10 a month or whatever, trying to pay down their bill. Okay. So these were like indirect collections. And so we would collect this money. And usually by that time, the appropriations, we didn't have the same lifespan of an appropriation back in the 70s. Remember, Rich yesterday was talking about this thing called M account. So most of the monies that we got in would end up just being deposited into the M account for that particular appropriation. Okay, that was that big pot of money that the Air Force was tapping into when they were building the B-1 bomber. But that's how that's worked. That kind of falls under this thing as an indirect collection. We were collecting on behalf of a dispersing officer. So it talks in here about collection agents, and I mentioned, their job was to collect, store, and deposit funds. They're held to the same rules though. So this individual that worked for me, she had to have a safe. If she got money in, she had to secure it for a maximum of 72 hours if actual cash did come in, and then it would get deposited. Okay, so she had to secure it. And again, the same rules as the dispersing officer had. She can't keep it. She couldn't use it. She couldn't invest it. We couldn't put it in the bank and draw interest on it. And she couldn't exchange it. Okay, it had to be secured and no later than 72 hours be deposited. Okay, so same rules. This here is a couple of collection and reporting systems that we currently have. Goals 2. This is used. We're going to be talking about some financial statements here later on, but these used to provide statements of accountability to the Treasury. I have some forms at the end of this chapter. You're going to need to know a couple of forms and actual form numbers that dispersing offices use. And so they use goals too for those types of things. I already mentioned IPAC. I would, if you have a book, I would highlight IPAC. You may get a question on that reads something like this: what is the payment system used between federal agencies? Okay, what is the payment system used between federal agencies? And the answer is IPAC, the Intergovernmental Payment and Collection System. And again, it's a way for federal agencies to transfer funds from one agency to another. Fairly standardized. Okay, so I'd kind of highlight that one. Some of these other systems, and these systems, every time we update the book, we have new systems in here. They're updating and changing all the time. This one is called CARS, Central Account Reporting System. And again, this is one of those systems that provides agencies with their fund balance with Treasury. Okay, captures and records Treasury symbol information for payments, things like that. Provides agency with one-stop access to both to provide and retrieve data information from the Treasury. So agencies use this as their link to the Treasury. And the last one is GTAS, government-wide Treasury account symbol. It's for adjusted trial balance symbol. Okay. This system replaced. We used to have these systems called Fax 1 and 2. They were legacy systems, which we would use for some of our reports to Treasury. Okay, so this is the new one that's replacing all of that. The one out of here to make sure you know is IPAC. As I said, these other ones, they tend to change all the time. All right, let's talk about debt collection here. I mentioned yesterday there was a law passed in '96 called the Debt Collection Improvement Act. And what that act basically said, required agencies, if you had any debt that was more than 180 days old and not in litigation, okay, it wasn't being fought in the courts, then you have to return that debt or refer that debt to the Treasury for action. So any debt that's over 180 days old, 6 months, and not in litigation, it goes to the Treasury for follow-on action. So debt collection with individuals, whether if you're a current military or civilian employee, or if you're a former military or civilian employee, there's some things that DOD, if you owe DOD money, let's say you were overpaid, you got too much on your travel advance, or whatever, if you paid too much, they will send you. They are required to send you one letter, one notification letter that explains how much you owe and why you owe that money. Okay, that's the agency's requirement. After that, they can check your pay. They're only required to send you one letter explaining how much is owed and why you owe that. After that, they can check your pay. Okay. That's the takeaway on that one. I don't have anything else. So that's for individuals. If you are a vendor, sometimes contractors are indebted to us. Contractors also get one notification letter. And, I mentioned that program the other day, TOPS, the Treasury Offset Program. That can be used both for civilians and for vendors. TOPS is it's a program run by Treasury. It has a crosswalk to, if you're a government employee or military, they have crosswalk to all your information. If you're a contractor, they have what is called your TIN number, your tax ID, tax information number. Okay, so they can do pay checkage or whatever. They could use this information to collect on monies that you owe them. So there are some thresholds here. If vendors do owe you money, and if it's threshold $25 or more, and if the tax protector has a tax identification number, these get referred to what's called the Debt Management Office at Treasury. If they don't have a tax ID number, it's got to be $100 or more to refer that to a tax to the Debt Management Office at Treasury. Also, Treasury keeps what is called a do not pay website. Okay, and this is used to verify eligibility for vendors, beneficiaries, things like that. Vendors that, so if you're getting a letter, a demand letter for payment, and you fail to respond to that letter, you get put on what is called the do not pay list. Okay, the do not pay list, and Treasury retains this list. They used to have another word for this, another term for this. It was called the holdup list. And if your name was on that list, dispersing officers, before they make a payment, they were supposed to check that list. And if your name was on that list, they did not pay you. Okay. So it's no longer called the holdup list. It is called the do not pay list. And again, this is for vendors that fail to respond to their demand letters. Talk about control of public funds. I've already mentioned some of this stuff. So if you have control of public funds, if you're a dispersing officer, they may have funds. Collection officers may possess funds. Cashiers, they may possess funds. Okay, you must be provided a safe. You must have a separate safe. You got to make sure you have good controls. It's got to be a secure container and so on. You want to write this down. At least semi-annually, dispersing officers shall make an inspection and maintain a record of the inspection to ensure that the safety office measures are in place. So you have to have internal controls, and every 6 months you need to make an inspection of those controls. Okay, and you have to maintain a record of that. And you've got to make sure you have controlled access to all this, to your safe. Remember when we were talking about internal controls, and I mentioned, internal controls are not always, they can be breached, they can be overridden, especially by management. If you are a DO, or if you are, as I said, a cashier or a collection agent, those folks, their authority, they may be your boss and whatever. However, you are responsible for the content of those containers. So unless these folks have access to that, have written access to those containers, they are not permitted to, they may be superior to you, but they are not permitted to have access to that information or to what's contained. Because you got to remember, you ultimately are responsible for that. If they don't have written access, then you would be deemed negligent. Okay, so dispersing officers, when they're doing their checks, I always like to ask the class, which of these are good? Out of balance, overdraft, or underdraft? And the answer is none of them. They're all bad, okay? They're all bad. You don't want to be out of balance, you don't want to be over, and you don't want to be under, okay? So out of balance, and you may want to write some of this down. It's considered a major loss, okay, if you are $750 or more out of balance, or if there's any if you suspect fraud, okay, it's considered a major loss. if it's $750 or more, or any loss involving fraud. That's considered a major loss. A minor loss is less than $750 without any evidence of fraud. Okay. Again, so minor loss is less than $750 with no evidence of fraud. Okay. And again, neither is good. Overdraft, the check is greater. Underdraft, the check is less. So I want to make sure all these balance out. Checks. And we have a couple of different types of checks here. Have these things called undeliverable checks. And it says in the book, the DO will attempt to deliver a check to a payee for a 60-day period. If after 60 days it's not delivered, it's considered an undeliverable check. A check that is determined to be undeliverable after 60 days is what it's called, undeliverable check. Old check, and says all U.S. Treasury checks are payable up to 1 year from the date of issue. So if you get a actual government check, it's good for 1 year. You might want to highlight that or write that down from date of issue. Okay. After that, it is no longer negotiable. It's no good after that. Okay. So if you have one of those, and let's say you get a government check and you put it in your desk drawer and you forget to cash it, after 1 year, it's no longer negotiable. Yeah, this is we sometimes, or we used to call these things stale checks. You possibly can get them to reissue it, but that check in itself is no longer good. Spoiled checks. A check that has become spoiled and non-negotiable should be returned to the dispersing officer. Okay, so let's say you got a government check and you have it you put it in the pocket of your jeans, and your spouse washes the jeans and it comes back and it's a pile of mush. Okay, that is what we call a spoiled check. And you want to make a note that only the dispersing officer has authority to reissue a check. Okay, so if it's spoiled, you could still somewhat, I don't know if it's readable or not, only the DO can reissue a check. You want to make a note of that too, the difference between an old check and a spoiled check. Another thing here, it's not in the slide. It's called the Barring Act. And the Barring Act, let me talk about this because I have mentioned it already. The Barring Act was passed back in 1940, okay, by Congress way back in 1940. And when they passed this, they made it retroactive. And they made it retroactive all the way back to the year 1775. Think about that. They passed it in 1940. And they made it retroactive all the way back to 1775. And I got an article here, and this is kind of interesting. And this came from GAO. And GAO put this out several years ago. And GAO was doing a study. They were doing an inspection to report to Congress about claims against the United States. And they started their report back to Congress, and they basically said, and let me read some of this. It said, we start this discussion by saying if statutes of limitations didn't exist, we would still be litigating Revolutionary War claims. So they go on and tell a story about the winter of 1777 rather. And this is when George Washington uh, was, and his troops. They were up at Valley Forge. Okay, they go on to say they were short of just about everything. They had no food, no clothing, no shelter, no ammunition. And George said, if we don't get help pretty soon, we're either going to just disband or starve to death. So they made a plea for donations and money. Well, there was this wealthy landowner in Pennsylvania by the name of Jacob DeHaven, and he's allegedly lent George Washington and the Continental Congress $50,000 in gold and an estimated $400,000 in supplies. A lot of money back then. This guy was pretty wealthy, I take it. And he lent them this money and these supplies on the condition that they would be repaid with 6% interest. Okay. This guy's descendants made a claim against Congress, or made a claim to Washington later on, that this loan was never repaid. And they've tried during the 1800s and the early 1900s. So in 1989, one of his descendants tried to sue the federal government on behalf of all the descendants. And he got his calculator out and he calculated that $450,000 in 1777 at 6% interest came to roughly $140 billion. But he'd probably settle for a little bit less if they would agree to it. Anyway, he didn't get anything. Bottom line, he didn't get anything. And again, it was because of this law, the Barring Act. This Barring Act said it was passed in 1940, and they made it retroactive all the way back to 1777. So what the Barring Act requires that the government to receive a claim within 6 years from the title of the claim accrues, and this is for other than entitlements. And if they don't get it within that 6-year period, then it's too bad. Too bad, so sad. So let me give you a little write-in here, something to write down in your notes about this. So write this down. There's no prescribed format for submitting a claim to the government. There is no prescribed format for submitting a claim to the government. However, it must be 1, in writing, 2, it must be signed, and 3, must be submitted within 6 years. Okay. There's no prescribed format for submitting a claim to the government. However, it must be in writing, it must be signed, and it must be submitted within 3 years. And that's the Barring Act. I'd mentioned earlier, when we used to retain some of our records, I was saying it was actually 6 years and 3 months. The 3 months were an add-on just for administrative purposes. But now with FIRE, we've extended that retention records just because of auditability. Okay, the last slide in this section. These are dispersing office reporting requirements. So these are some forms, and some of you may, have used some of these in the past that are used in dispersing offices. So the first one here, it's a DD form, and again, you do need, for testing purposes, we keep hearing that these form numbers are on the exam. There's a daily statement of accountability. It's a DD form 2657, and this thing must be prepared for each day that business is transacted. Okay. These are prepared by the dispersing office. So write that down. It must be prepared for each day that business is transacted. And I would kind of highlight this. This is one of those maybe on the test. The next form, it's a statement of accountability. And it's a standard form, 1219. And 1219 must be prepared monthly for each DSSN, remember dispersing station symbol number. And this is whether or not they have any transactions. They have to prepare this monthly. And these reports go to Treasury no later than 3 working days after the end of the month. They write that down. They're required to go to Treasury no later than 3 days after the end of the month. So they're prepared monthly. So basically, the DD form, the 2657, if you totaled all those things up for the month, they should actually tally up to that 1219 report. Those are the two I think that will most likely be testable on this. There's others, the daily agent accountability summary, a DD form 2665. There's a voucher control log, a 2659. Deposit ticket, you may want to, I got a note by that one. Standard form 215. And these are used to deposit all currency, coins, and negotiable interest into the Treasury. So if we get money that has to go to the Treasury, you use this deposit ticket, standard form 215. And when you see, like standard form, that means these things are used throughout the government. DD forms, of course, are going to be used only within DOD. So these are standard across the government. Last thing here, records maintenance. And so let me read what I got here. Copies of vouchers, books, records, and any other associated paper must be retained as government property and readily accessible to the dispersing office for a period of not less than 10 years. Okay. So all vouchers, records, and associated paper is considered government property, and it must be retained not less than 10 years. With the exception, and I talked about this when I was talking about civilian pay records, they are retained for 56 years. 10 years and 56 years. Okay. I told you finance, there's a lot of details in finance, a lot of nitpicky information in finance. I think though, if you focused on the ones I told you to focus on, you'll do well. Okay. Any questions on finance? Okay. I got, it's almost 20 after. Let's take 10 minutes, come back right before the half hour there.